Everybody who is fundraising feels like they're on the back foot. It's painful. It's not going very well. It's embarrassing, frustrating, and it's distracting from the thing they want to be doing, and they don't feel particularly good at it.
This doesn't work. I don't get that. This feels weak, blah, blah, blah. I don't have conviction. And I'm like, thank you so much. I say that after I sob in the corner for a few minutes. It's still hard to hear, by the way.
It'll be hard to not have what a friend of mine recently mentioned to me, this term sales breath. Feels like you're a little desperate.
Please fund me.
You're listening to the Startup Podcast. This is an educational episode.
Hey, I'm Chris Saad.
And I'm Yaniv Bernstein.
And on today's show, Yaniv is going to wear his heart on his sleeve and tell us all about his fundraising process. He's in the middle of raising money for his company. Now, we've talked about raising capital a bunch of times on this show, but never after we've been fresh on the trail. And so Yaniv has got some new thoughts, new feelings on the matter, and he's going to tell us all about it. What to do with your pitch deck and why is it like a product, early believers and how they open the door, how you can't please everyone, or at least Yaniv can't, the rejections and whether they ever stop hurting, why investors might be unable to invest in you, and then finally, why asking for money can feel embarrassing and what to do about it. All that and much, much more on this week's show. Stay tuned right after the break.
Listen up. I know a lot of you use dev agencies to help build your product. Problem is, a lot of those agencies suck. I've been looking for one I can really endorse, and I finally found one. Warp Development are the powerhouse behind countless successful startups and enterprises for over 22 years. They have 100+ experts who don't just code, they solve business problems. From custom software to AI consulting, Warp delivers results that move your business forward. And they're in your time zone. They have offices in Australia, the United States, and South Africa, so you get local support with global expertise. Are you ready to build something that matters? Visit warpdevelopment.com, that's WARP development.com, and mention the Startup Podcast for a free consultation. Today's episode of the Startup Podcast is brought to you by .tech domains. One thing about starting your startup that should be easy but isn't is naming it. Why is it so hard? Because all the good .com domain names are taken, so you end up doing something silly like misspelling it or adding random prefixes or suffixes. No more. Your domain shows your focus and intent, so you should make it sharp, clean, and unmistakably tech with a .tech domain. Head to get.tech/TSP or a registrar like GoDaddy to grab your .tech domain today. That's www.get.tech/TSP for the Startup Podcast. Okay, Chris, so a bit of a different one this week. I am currently in the middle of raising a pre-seed round for my own startup, Violet. And so going through the process of raising has just refreshed for me a lot of the things that we've taught, a lot of the lessons that we've taught. It's one thing to talk about these things because you know people who've done it, because you've been involved in some way, because you've been an investor, but I'm right in the middle of it right now. So it's all so fresh and raw. So I thought I would share with you all 6 lessons I've learned about the art of raising at early stage. We've got 6 learnings. And the first one, and I think you'll resonate with this one, Chris, is your pitch deck is a product.
Your deck?
Yes, my deck. I have a very nice deck. Thank you very much.
The slides that
my slide
pitch
deck.
your
Yeah, my
company.
slide deck. We're not in New
Okay,
Zealand,
got it.
my friend.
I was confused. All right, keep going.
What do I mean by that? So quite a while ago, we had a guy called Nira Zavaro on the show. He wrote a book called Fuck the Slides. And it's a fun book. But, actually, you still need slides, because what happens is when you are reaching out to investors, Chris, the first thing they want to see is your deck. They say, send us your deck. And this deck is what Nira called the toilet deck, right? Because they sit reading it on the toilet. This is not a long, detailed thing. It's something they need to be able to flick through. And the aim of the deck is to get them excited enough to actually take the meeting and allow you to pitch properly. And so I thought, I've seen a million of these. I've critiqued them. I've given feedback on them. I've been involved in raises before, helping critique the deck that has been created. But I've never been the person who has been primarily responsible for creating this deck. And now I have. And it is really, really hard, right? Because what you are trying to do is tell a story in a way that resonates with a lot of people when they only have a few minutes. And when I say it's a product, this is the thing I've learned. You can spend days, weeks even, in your ivory tower, iterating on this thing, trying to make it perfect. And then you send it to people and they say, I don't get it. I don't get this. I don't get that. I'm not excited. And that feedback they give you is absolutely gold. And so you take that feedback and you revise your deck and you make it a little bit better. And then you share it with the next bunch of potential investors. And then they're like, oh, I don't get the other thing and I don't like that and I'm not convinced by this. And you iterate again. And in just over a week of raising, Chris, I have revised the deck 8 times based on feedback. And so when I say the deck is a product, I mean it in the sense of you have to ship it and you have to take feedback and you have to iterate. And the only way you're going to learn how to make a great deck is by having that contact with reality and having that fast iteration based on user feedback. In this case, your users are potential investors.
Yeah, I think that's a really, I like the analogy to product. What you're saying there is you want to be agile with your deck, right? So you want to ship, learn, and iterate. I also find, of course, it's like product in 2 other ways, which is that you want someone in the process who has some amount of emotional detachment from your company, who can come in with fresh eyes every now and then and go, what on earth are you guys saying? This is really easy. It's just X for Y. Like, why are you overcomplicating this? I often find a key part of my advisory work is not that I'm any cleverer or more experienced than the founder. It's just that
Though, of course you are, Chris.
But of course, but it's just that I don't care, and I have a fresh pair of eyes, right? When I say I don't care, I mean I'm not sweating and bleeding and crying about the business every day. And so when I come in or others come in just clean, they're just like, man, this seems very simple. This is just this, and this, and then because of this you get that, right? And they're like, oh my God, how did you do that? I'm like, I'm not lost in the forest with you, right? Mm-hmm. And so you want a couple of people with you on the journey every week or 2 weeks to just be able to come in and go, I feel like this is very clear. Here's what you're not seeing. And also like product, and again, long-time listeners in the show will know what I'm going to say. It does take some amount of clear vision, taste, and judgment. I've found founders who are iterating on their deck after every meeting or after a number of meetings with VCs, but they're not iterating on it in a methodical, thoughtful, principled way. They're thrashing. So they take the last bit of feedback they got from the last random guy or girl, and then they like rethink their story or change their business model or what have you. So it is about, as with product, listening to your customers, but listening to their pain, like listening between the lines. Because the problem may not be with the business model, it may be upstream to the problem, or it might be downstream to the ask. And understanding also that just because they think something doesn't mean that your business should pivot or your story should pivot, because they may be a different kind of investor with a different thesis.
Or even that they're right in any way.
Or in any way, right. So that they might be wrong because they're a B2B investor and you're pitching a B2C company and everything for them looks like a B2B company. Like, you should change this to B2B. And that's just wrong because their thesis is wrong and they're trying to fit you into their worldview. And they may be wrong because they're in B2B and you're in B2B, but they're just shit. They're shit operators. They know at best they know how to allocate capital, but they don't know how to operate companies.
Absolutely. And again, we've talked about this in the context of products, but I was just shocked by how much it resonated with me as I was doing this pitch deck. When I say listen to feedback and iterate based on it, I did not say do what they tell you, right? The feedback is signal. Listen carefully, right? There is signal and noise in there. You have to extract the signal. Things they don't understand, perspectives that don't resonate with them. And so quite often what's happened is I've shared something and I thought it was a really great way of framing the problem. And I've heard from a couple of people that it just didn't resonate with them. They're like, maybe do it this way and maybe do it that way. The bit that was really powerful for me was the fact that it didn't resonate. Sometimes their advice was useful. Sometimes their advice was not. But what I knew is like, oh, they didn't get it. And these are the reasons they didn't get it. And then to your point, Chris, about taste, I then revisit this and I inject my own taste, my own sense of what the narrative needs to be to revise the slide. And hopefully it's better. But also notably, I won't know until the next time I share it with investors or other people for feedback, right? You only know the truth when your ideas meet the market. But yes, if I look at how the deck has evolved, there has been a North Star, there has been a guiding light, but I've progressively upgraded the way I have told that message so that people who, yes, are not really close to it, who are not in the forest, actually get it and say, yes, I understand what you're doing. And by the way, I'm not there yet. And not every increment has been better than, or not every iteration has been better than the one before. But I do think that over the process of the last 10 days, the direction has been correct. It has gotten better and better because I have been listening to the feedback, trying not to be defensive, trying to extract the signal from the noise, even if I don't agree with the person's feedback overall.
Yeah. And then one last point on this is this is why I often advise founders, especially first-time founders who don't have strong relationships, to first run what I call a roadshow before they run the fundraise. which is to say to people earnestly, not with some kind of Machiavellian doublespeak, I'm not raising money right now. I'm going to start raising money in 2-3 months. I'm here to learn from you and to see if we're a mutual fit. And I want to understand what you'd need to see to get conviction on this business, to get excited about partnering together. And so you have to explicitly ask them, at the end of your pitch or at the end of your conversation. So what do you need to see in the story, in the business, to get excited about this? And they will give you that feedback, because often, Yaniv, people are not going to give you the feedback. They're going to give you what's called the California no. Which, sounds interesting, Yaniv, but you're a bit too early stage for us. You're too little late stage for us, or we can't have to pass to this time, but we really love it. These are all sort of soft no's, but you need to get real feedback. So make sure you don't leave the meeting until they give you at least one real thing. And sometimes, if they're going to pass, or one real introduction to the next guy. Okay, well, so if it doesn't fit your thesis, who do you think might be relevant for us?
Well, here's the interesting thing, right? And I acknowledge my privilege here, and this is the way it's played out, which is not in exactly the way I expected, right? My privilege being that I know a lot of people in the community, and I'm somewhat well known in certain circles, right? Which means I thought that would mean, okay, everyone takes my call, and that's somewhat true. I'm able to have access to people, but the real privilege that I didn't expect was that I don't get California no's. I get punched in the face, right? Because what I am getting is radical candor from people who actually care about me and actually care about helping me succeed, right? And so instead of just doing the comfortable thing, the easy thing, which is just to be like, oh yes, it's not the right time, whatever. It's like, they're like, this doesn't work. I don't get that. This feels weak, blah, blah, blah. I don't have conviction. And I'm like, this is gold. Thank you so much. I say that after I sob in the corner for a few minutes. It's still hard to hear, by the way, but I accept that it is incredibly valuable. It's a privilege for me to be able to get high quality feedback like that from people who are smart. I guess my point is, some people will have more privileged access than others. But when you talk about that roadshow, Chris, where do you start? Start from the position that your pitch is not going to be very good, right? Like a product, your first version will be embarrassing. And so you want to pitch it to people who actually care about you, who will give you good feedback. Who are those people? If you're lucky, those are people who are actually investors who know and trust you so much that even if you give them a shit pitch, they will listen to you and they will give you good feedback, and they won't just pass either. They'll be like, come back to me when your pitch is better, because I'm sure there's something good there. If you don't have that privilege, who is in your life who, like to your point, Chris, who will give you that honest feedback? Even if it's just your partner, right? Like, of course, the more industry knowledge they have, the more industry connections they have, the better. But keep working back from the ideal until you find someone who ultimately cares about helping you succeed more than they care about not having an uncomfortable conversation, and get their feedback.
As you were talking, I was reminded of that old story, that old game of the paperclip. Have you ever heard of that story of the guy who started with a paperclip and he traded up just a little bit over and over and over again, and in the end he ended up with whatever, a car or a house, some
This
big
is a
thing.
true story, by the way. It was in the old days of the web. It was called One Red Paperclip, I think. He sort of journaled the whole thing.
He would go to people and say, okay, I'll trade you this paperclip for a lighter, and with the assumption that a lighter maybe is just a little bit more valuable than the paperclip. And then he would trade the lighter for something big, bigger again, and then he would trade the thing for something bigger again. And so, as Yaniv said, compromise as little as you can. Go find the very best person you can talk to pitch to, the very best, and try to get away from real estate agents and plumbers, and I mean that without no offense to real estate agents and plumbers.
No offense to plumbers anyway, right, Chris?
That's right. What can you do? But someone that is as close to the tech game as you can get, because the rules are very different than normal small business, and then try to trade your way up. Like, hey, do you know someone that's in tech or run a startup before, and just try to get as close to the sun, I guess, close to the insiders as you can, as fast as you can.
Exactly. So, you have the level of privilege, the level of access that you have, but that is the way to work it. No matter what level you're at, you still want to go that same process of, in a sense, trading up, right? Like I said, there are investors who I would like to have on my cap table, who if I went straight to them with a shitty pitch deck, that would just burn the bridge, right? So I go to my trusted people first. Some of them give me money, some of them just give me feedback, but that is how I get to the point where I'm like, now I'm confident pitching to someone I don't know, someone who I really have to be buttoned up in front of. So yeah, it's been an amazing process.
You know what's great, Yaniv? If the deck is like your product, Pitching is like go to market. There's the classic adoption curve, technology adoption curve, which starts with the innovators and moves over to the early majority, the late majority, and then finally laggards. You got to go find the innovators, the people that you have access to, and you've got to incrementally work your way to the early majority and the late majority. They're the big fish and the people who you really want to reach. So, just like go to market for your product, where you start with whoever will buy what you've got, even though it is crippled and anemic in many ways. And then you've got to mature through the curve to the higher, better players. So pitching is like building your product and taking it to market. I think that's a really cool analogy.
Exactly so. And that's a perfect segue, actually, what you were just saying, Chris, to my next point, which is early believers open doors. And again, this is maybe something where I kind of knew it, but now I know it viscerally, right? And what I mean by that is when you do these early pitches and you find someone who is sort of forgiving and believes in you and believes in your mission and believes that you're going to get it right, and they get excited about what you're doing. And, and often they'll put in some money, but more to the point, they then become your champion. I didn't realize what a powerful dynamic that is. Like, sure, every time you get a rejection, you say, hey, can you refer me to someone else? That's useful. That is useful. But we had someone really early on, I don't know if you listen to this show, but if you do, you know who you are, who basically said, you know what, I'm sold, just take my money. This is someone I've worked with. I guess he trusts me. He believes in the mission. He sort of sees what we're trying to do, even if we weren't able to pitch it well. So he committed to put in a check, which has been amazing. But more to the point, he started, and this is an influential person in the startup circles that I'm interested in investor circles. He started back channeling to all of his friends. And he said, you've got to check out Violet. You've got to check the startup out. I really believe in what they're doing. I've already put my money in. You should at least talk to them. And all of these doors started opening, right? Not all of them resulted in an investment, but what I've got is someone who has become a cheerleader for me because he boarded, right? He's now an investor and he wants to make this round work. And it's a real sort of pay it forward sort of thing. I think he had help like that when he was raising, and now he's, a sort of Series C level founder, and he is going out there and really helping me and helping us. And I'm so grateful for it. But also it was just a real learning, which is like, if you start and just early on, you get one or two true believers who are as well connected than you or better connected than you, to your point, Chris, about working your way up the ladder, they can go there and they just start basically clearing the brush ahead of you. They clear the way, and it makes all of those later conversations that much easier. So find your early true believers. That is the most important thing, actually, to make the rest of the raise go well. And that's a surprising learning for me.
Yeah, this is something that we've talked about in a few different episodes, this idea that investors in second and third tier markets do not understand their role. They don't understand that as soon as the check clears and the money's in your bank, they're on the same side of the table as you. And their vested interest is to make the company as successful and investable as possible, because that's the way they maximize their returns. But in second and third tier markets, too many investors are inexperienced, and they think that their job is to take as much as they can for as little as they can, as quickly as they can, hobbling the company on day zero, wrecking the cap table, underfunding you, sitting back on their laurels, demanding things that they don't need to demand, and they're just shooting themselves in the face. And so what's supposed to happen, and this is sometimes just lip service and just, theater in the startup game, but what's supposed to actually happen is you're trying to raise money from people who add value beyond their capital. They add value through their advice, through their network, through helping you to raise, through back channeling, through being a source of validation and signal for you, through just enormous value creation. And so when you're raising money from angels, especially, but VCs, it's like you're supposed to be interviewing them. What do you know about our domain? What have you done before? What founders have you helped? Tell me a time where the business has not been going well and you've stepped in to help. This idea, Yaniv, that your early investors or your investors in general should be running out ahead, introducing you to their friends and to other investors and back channeling and helping to push the round. Like, this should not be a miracle. This should not be an early believer thing. This should not be like a kind pay it forward thing. It's in his financial interest to be doing this. And too few investors do this too little. And so it's great your friend is doing this. I encourage everybody who is investing at any level, angel all the way through to institutional, to consider what role you're playing in making these companies successful quickly.
One final nuance on that, I think it's true. Everybody should be helping from early on. But if you get early believers who are really passionate, there are some people who are like, yes, I'm going to take a bet. There are other people who are like, I want to make this succeed. But also, how influential are those people? You want to look for people who can give you that kind of network effect, right? Where like, because they're on board, they will bring other people on board. And that's really, I think, one of the quiet secrets of how you put together a raise is that the early commits start working to get those later commits. I guess what I didn't realize, and it's a nuance, it's a special case of what you're saying, is it's nearly this snowball effect, right? Where, yes, this person isn't helping me with a future raise. He's helping me with the current raise. One day I get a commit. The next day, I'm already getting help with the raise, meaning the fact that I got this person on board early makes the rest of the raise more likely to succeed. And so there is this element of like, how do you get those early believers in the raise to make the rest of the raise more feasible? And, again, by the way, this raise is not closed. So, I'm sort of sharing like how I'm feeling right now. I've already gotten enormous amounts of help and hopefully this will result in a successful raise. But the amount of friction that it's cut out has been really remarkable. Looking for a tech partner to scale your business? Here's one I can personally endorse, Warp Development. With 22 years of experience and 100 plus experts, they deliver custom software and AI solutions that drive results. Visit warpdevelopment.com and mention the Startup Podcast for a free consultation. All the best .coms are taken or crazily overpriced, so you settle on a workaround domain for your website. Don't compromise. Get a clean, sharp .tech domain that instantly says, this is a tech startup. Grab yours at get.tech/TSP for the Startup Podcast or via domain registrars like GoDaddy. All right, so that brings me to the third thing that I've learned about the art of the raise, which is you cannot please everyone.
Speak for yourself, Yaniv.
More deck jokes are there? Okay. You can't please everyone. And this goes back to the first point, right? Which is your deck is a product and you get all of this feedback. And like I said, there is always value. Every bit of feedback is a gift. Every bit of feedback has signal. But if I were to try to actually create a deck that everyone was like, yeah, this is the sort of deck that I want, I would fail, right? Because people are looking for different things. I literally had directly contradictory feedback on my deck within the same day. Has too much text. It doesn't have enough text. It doesn't have enough information. Too visual, not visual enough. And so, these are somewhat stylistic, but the point is you need to have a point of view. You need to get used to the idea that no matter what you do, you will face negative feedback. You will face rejection. You will have people telling you to your face that they don't believe that what you're doing is right. And it's not easy. I'm not finding it easy, but you have to be comfortable with the idea that you cannot please everyone, because going out for a raise and trying to be a people pleaser and convince everyone, no matter what their own personal biases are, their background, their lens, that what you're doing is the right thing to do. That is exactly, to your point, Chris, where you end up with no real vision, no North Star, no taste. You become a weather vane, you become compromised, you lack cohesion, and that is actually the sure path to failure.
Yeah, this is what we touched on in the first point, right, Yaniv, which is you need to listen carefully to feedback, but you can't thrash and twist yourself into a pretzel trying to make everybody happy, especially people who are the wrong kind of people. And boy, oh boy, does this so completely and easily map to product, right? If you listen to all of your customers or you listen to the whole market, you are likely to build a bunch of random features that don't ladder up to use cases and to clear and end-to-end value, which is why you have to pick your customers in embarrassingly narrow ways, define them in very embarrassingly narrow ways and pick them very intentionally. Otherwise, the feedback you're getting and the requirements you have to deliver on are random. They're sort of all over the map. And you're not going to win. And this is the same thing that's true with investors. You need to do a little pre-qualification. You need to say, look, are these guys B2B or B2C investors? Are they early stage or later stage? Do they like marketplaces or social networks or pure SaaS or AI? Like what category are they in? Are they revenue focused? Are they growth focused? And if you're pitching your amazing, early stage B2C marketplace that's focused on growth to a traditional Australian investor who only understands B2B, later stage, post revenue, and only wants to get to break even, They're going to give you all sorts of stupid advice that it just doesn't line up with what you were trying to do. You have to get opinionated, and then you have to qualify the people you're talking to, or at least talk to everyone if you want, but just don't be distracted by the people who you know are not in your sweet spot.
Yeah, look, I mostly agree with you there, but there's a nuance that I'm discovering, right? Which is that investors, for the most part, don't necessarily know what they like. And what I mean by that is there are some investors who are super disciplined. They say, we only do mid-market B2B SaaS. And if you're not mid-market B2B SaaS, they will not even look at you. But the truth is a lot of investors, especially at the early stages, especially angels, but even early stage funds, are like, they're not quite sure what they're going to like until they see it. And you don't really know who you're going to be appealing to. So again, back to the product analogy, right? You can have a clear vision of what it is you're building and what value it provides. And you can have an idea of what your target market is, what your target vertical or persona or profile is. But sometimes the market will surprise you and you need to listen to it, right? Meaning you think that you've built a product for cohort A, but cohort A don't like it that much. But cohort B, who you weren't actually thinking about, they're starting to resonate. They're starting to get usage out of your product. And you're like, well, instead of ignoring that fact that people aren't using the product the way I thought they would, or that, the wrong people are using my product, let's learn from it and double down on it, right? And I think it's the same with investors. So yes, pre-qualify to a certain extent. At the very least, know whether you are, you're after a long shot or a relatively safe bet. But I would actually encourage people not to narrow the field too much before they get out there, because sometimes you'll be surprised by who gets excited by what you're building.
Yeah, and you're right. Especially angels will have no earthly idea, right? They're investing based on their gut feeling. And you're right also that some institutional investors have an ill-defined sense of what their thesis is and what they're looking for. Just like product and just like sales, I would encourage you to ask them and force them to think about it. Like, hey, do you guys tend to like B2B or B2C? Do you tend to focus on growth, or do you tend to like revenue? And hey, do you like marketplaces? Do you tend to like, pure subscription SaaS? Help me understand how you guys think about the world. What's your general proclivities? And sort of encourage them to think about their thesis firstly, explicitly, and then to share with you. It's a cheat code. Most of the first sales call should be, tell me about your problems. What do you think about the world? And give you an opportunity to qualify them. Remember, you're interviewing them. They think they're interviewing you. But the more you interview them, the more sophisticated you appear and the more likely you are to get funded, actually. You're also right, Yaniv, that, I don't know if you just said this explicitly, but you reminded me of the idea that even the funds that have very clear thesis of what they're looking for, and even hard rules, will break those rules if they like you enough, right? So they go, holy shit, this company is growing like a weed. And wow, this founder is, X this and X that, and from Silicon Valley and YC, and take our money, please. And like we want to be in on this deal. And so yeah, it's again another art, and it's not science. And so yeah, just you got to get in there and feel your way through.
I guess one thing I would add though, Chris, everything you say is correct. It's advice I've given myself. It is hard when you're in the thick of it. You're like, I have to raise a bunch of money. I'm walking around asking for money to remember that you're interviewing them. It is hard to have that abundance mindset when you're in the room saying, damn, I really want these people to say yes because I need money to fulfill my vision. So, I think I've gotten even more sympathy for the emotional journey that you go through with that, but it doesn't make the advice any less true. I'm not sure I always do it right though.
Actually, this reminds me of the last bullet you have here, which I think we should just skip to before we go into the other bullets, which is that the rejections don't stop hurting. I'm assuming here what you alluded to earlier, which is you go and have a bit of a cry afterwards, even though you got to keep moving on. I think it's really important for you, for our audience, that you are admitting this point. I'm admitting it for you. It never feels easy. If you are, a nobody, you'd expect it to be hard, but it's going to be even harder than that. And if you are, a little well-known like Yaniv, you're going to expect it to be a little easier, and it'll be harder than that still. The rejections will always hurt. It'll always feel like you're in there begging for money, and it feels kind of weird, even though you're not, right? You're selling part of your company, part of your value, part of your journey. You're not begging for money. It'll be hard to not have what a friend of mine recently mentioned to me, this term sales breath, where it feels like you're a little desperate, and it comes across.
Please fund me.
This notion that everybody who is fundraising feels like they're on the back foot, that it's painful, that it's not going very well, it's embarrassing, it's frustrating, and it's distracting from the thing they want to be doing, and they don't feel particularly good at it. There's a rare few living in rarefied air where the checks just kind of flow in and they can focus on, blowing the doors off. I'm sure Sam Altman or Emil Michael might be in them.
100 or 200 people worldwide who, early stage especially, of course, like, if you've got like a crazy rocket ship company and you're raising Series B, everyone will want to pile in. But if you're raising pre-seed, there are a couple of hundred people in the world who will basically be able to get a check from every single person they talk to.
It'll feel easy, right? There are certainly stories you hear, our friend of the pod, Jeremiah, and others who talk about, trying to cram into oversubscribed deals, and somehow and sometimes these startups get a buzz and they get momentum and they play their cards exactly right, and they have the exact right pedigree and the exact right story. It's just like finding product market fit, right? We're going to keep going back to this analogy of product and go to market, and so all of a sudden the product starts getting pulled out of your hands. Right, and the deal starts getting pulled out of your hands, and you're oversubscribed and stuff. But this is just so rare. It's so rare, and it's rarefied, and it's going to feel like shit, guys. And just know that that's okay.
I was speaking to a successful founder the other day who said that in their initial rounds, they got about 65 no's for every yes. Can you imagine what that feels like? The amount of rejection just day after day. And, I'm reflecting, I'm early in my raise. I probably had about 2 no's for every yes. I expect that ratio to get worse, right? But actually, I'm batting a pretty good average right now, but it sure doesn't feel like it because I'm still getting twice as many rejections as I'm getting acceptances. And I know it's going to get worse because I think as I expand my circle to people I don't know as well, to funds who I have fewer connections with, they're more likely to say no. And I know most of the pitches I've made where I haven't heard a response yet, they're going to result in no's. And I'm not looking forward to that, I'll be honest, right? So it takes a certain type of zooming out and resilience and just realizing that unless you're in that elite circle, you will get substantially more rejections than you'll get acceptances. And the rejections can be for all sorts of reasons. We'll come to that in a moment, right? So it always feels like a personal rejection. Sometimes it is, sometimes it isn't. Quite often you can't tell, to your point, Chris, because of the California no. Sometimes people are like, I can't invest right now because I don't have enough money. And they actually don't have enough money. And sometimes they're saying that because it's an easy excuse. So you never know. And so it's always hard not to take it personally.
Which sounds like it brings us to the next point, right, Yaniv?
It does absolutely bring us to the next point, which I think has been a really interesting one, which seems so obvious, but I've learned it in interesting ways. And this is, investors don't invest unless they have money to invest.
Shocking. What?
It's a tautology, but... And again, I'll put that California no in there as a caveat because I think saying I don't have the money is an easy and convenient excuse, but it doesn't mean it's not a true excuse a lot of the time, right? You talk to people, they're happy to take your conversation and they're excited and they're like, well, I guess I've heard 2 versions of this, right? One is the angel version, which is I don't have the liquidity right now. Quite often these are angels who are either founders themselves, they're relying on cash flows from secondaries, things like that. They also have a spouse who has to agree to this thing. And sometimes they feel like they have the money, but the spouse is like, no more investments for you this year. You've already put too much of our money into illiquid, high-risk vehicles. No more angel investment. And at least some of the no's I've gotten, I'm fairly confident that it wasn't a California no. That was the genuine case. Angel wanted to invest, but they couldn't part with the money. Funds, there's an even more wonky nuanced part of this, which is fund timing. There is one fund we spoke to who shall remain nameless, who we pitched and they're like, we literally have no money. We need an exit. Like we have no cash to deploy. But when you talk about funds having dry powder, right, there's a fund and maybe it's 3 years in and they're 60, 70% deployed and you're like, oh, well, you still got money. And they say, oh, we have a fund timing issue. What does that mean? That means that VC funds typically operate over a 10-year time horizon. They're supposed to return cash to their investors within 10 years. If they're already 3 years in, they've pretty much done their deployment, right? The money that they have left is what they call concentration capital, right? That's money that they're going to be using for follow-on raises, for doubling down on their winners, and less frequently for making a slightly later stage investment or an investment in a company that they see could potentially give them a return sooner than average. But if they're like, hey, I'm an early stage company and I want to get your capital. And they're like, well, we're 3-4 years into this fund. We can't put capital in. In the meantime, we're raising our next fund, but we haven't finished closing it yet. And so there's just no money that is suitable for you. And I think that's actually a really common problem and something you don't come across unless you're already in VC or you're experienced at raising, which is that not all money is equal, right? Not all money can be put to all purposes. It's not fungible within the context of venture capital. And so starting to get more literate about that and just understanding that there are plenty of people you'll speak to who may in some sense be interested in investing, but that their bar is so much higher or that they have specific requirements that you cannot meet. And effectively, if you cannot do that, then the money just isn't there. And I think that's a very common reason for rejection.
Some founders may be surprised to know how much being a VC is like being a founder. The VCs, the GPs.
Turtles all the way down.
Yeah, the GPs in a fund have to raise their own money from LPs, limited partners.
Which is just a fancy word for investor. An LP is just an investor in a VC fund.
Right. And so the VCs have gone through this journey themselves, if not in their own startups prior to being VCs, then at least for their firm. And I'm in some back channels with some VCs, especially early stage VCs that are still booting up or their fund or having their second fund. And they're just as despondent and depressed and anxious and frustrated as the founders are, trying to raise money and in many cases failing because it's a really crowded and difficult market right now.
A little sidebar on that, Chris, which I think is really interesting because there is that frustration, and we're recording this 2 days after the Figma IPO, which is the first good IPO in years, really. And there is this concept of this liquidity crunch, the exit crunch, which is that we've got a lot of unicorns, a lot of big tech companies. We've had very few large exits in recent years. And this is how it goes all the way down to affecting early stage founders like you or me, which is that because these funds have not provided big distributions, right? Actual cash distributions back to their investors. Quite often, when you're an LP, you rely on getting the cash back from your investments in order to then be able to commit to your next one, right? So if there's no liquidity, then the LPs are wary of committing to the funds. Right? It's harder for funds to raise their next tranche. Because of that, because the funds have trouble raising, then often they are stuck only with these sort of older vintages and they have quite a lot of trouble raising the new funds. And so then when you're an early stage founder, you're like, well, I would like to get your investment money. And they're like, we'd love that, but we haven't had any exits. We're having trouble raising fund 2 or fund 3 or whatever it is. And so right now we're basically not making new investments. Even though on paper, you look at their balance sheet, there's plenty of dry powder, they're not in a position to make new investments. And so this is like just connecting the dots between the whole VC ecosystem. IPOs, well, exits in general, IPOs in particular, they matter to everyone, whatever stage you're in. And definitely early stage land is feeling the impact of the lack of exits right now.
Yeah, but I want to address this question of after you've pitched an angel or a VC, and they're like, well, we don't have any money to invest, if we're honest. That's a little bit of bullshit. So let me talk about this. There's 2 kinds of angels, of course. There are amateurs who, go about their day playing golf and hanging out or running their own startups or what have you. And they put in a little money here and there and they don't think about it too much. They don't have a clear thesis. They don't have allocated funds. It's not part of a well-managed, well-curated family office or portfolio. And yeah, you might talk to them and they're like, oh, Yaniv, sorry, mate, my wife's up my ass. I've put too much money in startups, or we're not feeling like we can invest right now. That makes a certain amount of sense. But then there are these professional angels that make this, if not a full-time living, at least a part-time living. They've allocated a bit of money to this. They have a certain amount of bullets they can fire, meaning a certain number of startups they can invest in, their 10, 20, 30, 50K checks. And they know whether they have capital or not. And they should not be wasting your time listening to your whole pitch and then say, oh, sorry, I don't have actually any money right now. And the same is true for VCs. If VCs that are in that awkward stage you just described, these guys are professionals. They're institutional. They know how much money they have put aside. They know whether they have dry powder. They know whether they've returned the fund. They should really not be out there in the ecosystem wasting founders' times taking pitches when they don't have capital to invest. This is a little bit of a problem that you need to watch out for.
I don't totally agree with you, because what happens is it tends not to be binary, right? What happens is the money starts drying up, right? Like, I'm the former type of angel investor. I make a number of relatively small investments, and I'm sitting there looking at my portfolio, and my portfolio on paper looks pretty good. I've got big markups. I'm like, wow, I'm kind of rich off that portfolio. On the other hand, I've gotten very little cash out of this thing, and there's not really any out on the horizon. So in a sense, I'm fully allocated, right? I don't have enough cash sitting in the bank that I'm comfortable putting more of it into these illiquid investments.
But you should say that to the founder before they meet with you, right?
But there's a but, right? Which is if someone is just really remarkable, if I'm like, if I see an opportunity that I can't refuse, I'm not literally broke. I've got money I can put into it. That the bar is getting higher. And I think it's the same for these VCs, right? As the money dries up, the bar rises. It's not like a switch that flicks on or off. But what happens is when you're pitching to someone who is starting to face a liquidity crunch, they're just going to be so very, very picky that your odds of getting a yes become lower and lower.
In that case, saying, sorry, Yaniv, we don't have the money is a lie. They do have the money. It's just that you haven't crossed their bar. Any great investor is only making a few investments a year, a lot less than you'd expect. And they're only investing in the very best companies that they can invest. If they're a great investor, they're a great capital allocator. And so the bar should already be high. And maybe in this market or in a given macroeconomic climate, the bar will be even higher. But the answer to your question, the answer to your pitch is not, sorry, I never have the money. It's, sorry, we're going to pass. You have not met our bar. And so the feed that I would say that we don't have any money answer, if it is in fact based on what you're saying, you're not meeting our new higher bar, should be, we are going to pass. We don't buy this, that it meets our fund's needs this time.
Yes, you're right. But I think, we're playing very subtle semantic distinctions here. I don't think they just said they didn't say, I don't have the money. They said, look, it's a liquidity situation. We need to show a faster return or whatever. And it's not the right stage in our fund for us to invest in you. And yeah, of course, if I came in there, if I was Mira Murati, I could go to any fund in the world and they would invest in me, right? Because I'm royalty, right? They would find a way to get the money. So yes, it's always relative to this. But I would say the point is VCs would like to say that their bar is held constant. I don't believe that's true. I believe the bar rises as cash runs out. And that's just a very human thing. Okay, so we're up to the final point now, Chris, which is a personal one, right? Which is asking people for money is embarrassing. This is sort of the flip side of the rejection thing, which is we've kind of touched on it. We don't have to labor the point here too much, Chris, but it's like you are going out there. Sure, you're selling an opportunity, right? That feels clean in theory, and it's true, and you have to remind yourself of that. But ultimately, going out there asking for money, it's one thing to ask for money from large institutional investors. It feels clean. That's what they do. But let's talk about angels, and let's talk about how these different learnings interplay with each other, Chris, which is I talked about early believers open doors. We talked about the sequence with which you should pitch to people, that you should have your trusted people who you know and who care about you first to give you the feedback. So what does that mean? That means that the people who are most valuable to you in the raise are people who you know, who you have relationships with, who may be those part-time angels. They may be founders, they may even be family and friends, right? You're going to them for that feedback. And ultimately, you're then asking them to give you money. And I find that kind of embarrassing. Sometimes it's awkward because I'm like, oh, here's someone who I really value, who would be great on the cap table. They're a friend, but we haven't been in touch for 3 or 4 months. And suddenly I'm coming in, someone out of the blue saying, hey, mate, how's it going? Oh, by the way, would you like to invest in my company? It feels like you're adding a mercenary element to something that is somewhat a personal relationship. And so, I found it embarrassing. I also think that is the game that we're playing, right? That if you really care about raising for your startup, you want it to succeed, you're running a process, you need to go to those people who are close to you. And, you don't bully them, you don't push them, you don't pressure them, you don't force them. But do you ask them? Hell yeah, you have to ask anybody who you think might be a good investor, even if they're close to you, especially if they're close to you. You need to go out there and offer them this opportunity.
Yeah, that totally makes sense. And as you say, for me, this is sort of 3 concentric circles. If I would be going to friends, family, and fools, right? Amateurs in my life who maybe have a little bit of extra money for the pre-seed round, that definitely feels awkward, embarrassing, stressful. You don't want to, lose their money. You don't want to damage your personal friendship if they're forced to say no or what have you. That is really difficult. The next concentric circle out is your industry friends who invest professionally or semi-professionally, and maybe you haven't spoken to them for weeks or months, and you're re-engaging with a purpose. I tend to feel not so bad about that. It's like, this is what you do. This is what we do. This is what I do. I am bringing to you an opportunity to, invest in me. You know me, you like me, you've seen my work. It's professional. We're having a conversation in a professional context. Here's what I'm working on. What do you think? Do you want to be involved? And I tend to not take that too personally, because what you have to remember is this is sales. It's sales. This is a job. Their job, at least part-time, is to invest, and your job is to build your company and to sell your equity. You're not asking for money. You're selling your equity. And this is even more true on the third concentric circle, which is institutional, VCs, right? This is literally their job. They wake up 9 to 5. Their job is to sit in those like fancy offices, allocate capital, take pictures and allocate capital, and then support the companies whose capital they've allocated to. And so their job is to talk to people like you, right? And so in that third concentric circle, you need to let go of the embarrassment. You need to definitely let go of the idea that you're quote unquote asking for money. You're not asking for money. You are selling them equity, or at the least a promissory note for equity in the future. And so go in there and go, here's what I got, guys. Here's what the problem is, the solution. Here's what we're doing. Here's the methodology. And would you like to buy some of this equity and come along on that journey and bet on the upside? Yes, that's the attitude you got to go. I'm not saying this is easy. I'm not saying it's not demoralizing and dispiriting when they say no. Just like sales, by the way, when you lose that big logo, but you have to have this mindset or it's going to get in your way.
No, I completely agree with that. And actually, I just wanted to kind of go back to the previous point about investors who don't have money can't invest, right? There's a flip side of that, right? Which is people who do have money are more likely to invest, right? That's the converse. And especially when you're dealing with personal relationships, there is a calculus in the back of your head, which is how much money does this person have? And it's not a comfortable thing, especially if you've got a personal relationship. You're like, oh, is this person actually positioned to be an investor? Have they just sold a business? Have they just had some sort of liquidity event? Then they're much more likely to invest. Have they just become a founder themselves and stopped paying themselves? They're much less likely to invest. And so it's definitely a screening factor. And I always feel a little bit icky because I don't really like to think about a person's personal financial circumstances in general in a social relationship. But in terms of whether you can get them to write you a $25,000 check, then of course, for some people that's quite easy. For other people, that is laughably out of reach. And if it's people you probably have a sense of who's who.
And the other thing I want to stress is this idea of Silicon Valley versus the rest of the world. In Silicon Valley, founders are regularly investing in each other and sort of hedging their bets by taking a piece of each other's companies, even if it's just 5 or 10K or what have you. They talk about angel funding a lot. They talk about the rounds they're in. They talk about, their circumstances. It's in the air. It's like, hey, man, do you want to come for a coffee? Do you want to buy a bowling ball together? Do you want to go for golf? It's more casual and more common. Whereas in markets where this is not as much in the water, it's not as pervasive, it can feel more unusual, more risky. In some cases, if you're asking a friend for money in that first concentric circle, it can feel like icky, like, oh, is Yaniv struggling for money? Like, what's going on there? Because they don't understand that raising money is an opportunity for them, and that you're not asking for money for your family, you're asking for money for an opportunity. There's this cultural overhang that people who ask for money must be in desperate circumstances. And so, yeah, these amateurs, these friends, family, and fools, it would just be very embarrassing if you're in a second-tier market and they're just not used to people going around talking about investment in startups.
All right, I'm about to go meta here and reveal my hidden ulterior motive for this whole thing, which is, if asking people for money is embarrassing, and I've got a whole audience of people listening to this, are you an angel investor? Would you be interested in learning more about investing in Violet? That's right, I am asking you for money, or rather, Chris, I am offering all of our listeners the opportunity to become investors in Violet. So seriously though, if you do a bit of investing and you're keen to learn more, hit me up in your DMs.
Hey, wait, are we getting like a carry on this? Yaniv, is the show sponsoring this?
Oh, I'm getting carry on it. You just get to ride in my glory.
Okay, sounds good. So I guess this is the time for my plug too. Don't hesitate to reach out to me if you're looking for help, fundraising, or anything else to do with your startup. You can learn more about that over at chrissaad.com/advisory, or subscribe to my newsletter at chrissaad.com/newsletter. All right, Yaniv, well, this is a fun one as always. This is a topic we can never really stop covering because there's just so much to raising money, and there's so much nuance and subtlety to it. And the analogy of sales and the analogy of product and the analogy of go-to-market, I think, is a really powerful one. And it's good to hear, your fresh hot takes being on the road and doing this job.
This time it's personal. All right, mate. Well, it was fun to talk. Yep, that's the pod.
All right, catch you in the next one.
This episode of the Startup Podcast was brought to you by Warp Development. I know a lot of you rely on dev agencies to help build your product. Problem is, a lot of these agencies suck. Ask me how I know. I've been looking for one that I can really endorse, and I have finally found one. Warp Development are the powerhouse behind countless successful startups and enterprises for over 22 years. They have over 100 experts who don't just code, they solve business problems alongside you. From custom software to AI consulting, Warp Development delivers results that move your business forward. And they're in your time zone. They have offices in Australia, the United States, and South Africa, so you get local support with global expertise. Are you ready to build something that matters? Visit warpdevelopment.com, that's warpdevelopment.com, and mention the Startup Podcast for a free consultation. Today's episode of the Startup Podcast was brought to you by .tech domains. Naming your startup should be easy, but it isn't, because all the good .com names are taken or wildly overpriced. No more. You don't have to compromise. Your domain shows your focus and intent, so make it sharp, clean, and unmistakably tech with a .tech domain. How do you do that? Head to www.get.tech/TSP or a registrar like GoDaddy and grab your .tech domain today. Get.tech/TSP for the Startup Podcast so they know you came from us.